Good evening, all of you. I hope you all are doing good. So, this is the discussion of your revision test papers for your November 2022 exams in full English. Okay. So, today we are going to discuss the revision test papers, direct tax revision test paper of CA final MCQs, mainly the MCQs, because this time the MCQs which has been put in the RTPs have been very competitive. So you have to pay absolute attention on each and everything that I am trying to discuss in this particular session. Okay. Now, first of all, there is some kind of lecture which is given over here in the form of that you will be eligible for amendments. You are liable to understand all the amendments which are made by CBDT up to 30th of April 2022 for your November 2022 exams. Okay. So that is something which is a very routine discussion which is given over here. Now, in all, there are around 15 MCQs, out of which 10 MCQs are given in the form of case study scenario, and 5 MCQs are independent MCQs which are not dependent on any particular factor. Okay. So, we need to understand all of them one by one. Are you there online? Am I audible? Am I audible? And I want your response over here, please. That will make the session very energetic for all of us. Are you there online? Can you listen to me? Anyways, this is the first case scenario MCQ, which is a very critical section, which is on ULIP and life insurance policies. Okay. So this is on ULIP and life insurance policy. So let me read the question once and then I will discuss the answer of each and every MCQ one by one. Good evening, Shashank. Good evening, Varsha. First of all, wish you all a very happy Independence Day. Wish you all a very happy Independence. Mr. Manoj, aged 45 years, is a resident Indian who has the following insurance policies, some of which are ULIPs. The details of the policies are given and under. So he has total 6 policies, out of which 2 are normal life insurance policies. This and this is a normal policy. And the next 4 are ULIPs. Okay. And for ULIP, you might be knowing that there is some amendment which is made by Finance Act 2021. Now, A, B, C, D, E, F. 2 are normal insurance policies and 4 are ULIPs. Now, let us talk about the further discussion, the further information which is given in the question. The further information which is given in the question is date of issue, annual premium, date when the premium falls due every year, date of maturity and consideration received during maturity, and sum assured. Then there is further information which is given below the table. During the previous year 21-22, Mr. Manoj has earned a dividend of 12 lakh rupees. He has earned some dividend of 12 lakhs from shares of Indian companies and long-term capital gains of 5 lakh on sale of land. Further, he has deposited 1,50,000 in National Pension Scheme Tier 1 account of the Government of India. Mr. Manoj does not, hello Sachin, hello. Mr. Manoj does not opt for section 115 BAC. So first of all of us have to go through the entire table properly. Okay. So the table says that there are 2 normal insurance policy, policy A and policy B, and there are 4 ULIPs B, C, D, E, and F. Now let us read the question. That is the first MCQ. Now first MCQ, what does it wants to say? Let us read that particular question precisely now. Which are the life insurance policies excluding ULIP? The first question is not on ULIP. It is on normal insurance policy. It is not asking question on ULIP. So ignore ULIP in the first question. Which are the life insurance policies excluding ULIP in respect of which Mr. Manoj would be eligible for exemption under section 1010D in respect of maturity proceed? This is the first part of this question. So the first part of the question, let us try to solve that first. The first part of the question says that which of the insurance policy will be exempt excluding ULIP. Don't talk about ULIP as of now. So let us try to understand which are the policies which are exempt. Now only 2 policies are there which are not ULIP. Rest of them are ULIP. So we need to answer between A and B, which is exempt, which is taxable, or both are exempt or both are taxable. Let us talk about that. Now, what is the condition of exemption for normal policy? The condition of exemption for a normal policy is that your annual premium should not exceed 10% of sum assured if the policy is issued on or after 1st April 2013. So if your policy is issued on or after 1st April 2013, your annual premium should not exceed 10% of sum assured. In case of normal persons and in case of disabled person, it should not exceed 15% of sum assured. In this case, Mr. Manoj is a normal person. There is no question of disability in this question. So we need to check whether the sum assured and the annual premium is exceeding 10% or not. In first case, the annual premium is 50,000 and the sum assured is 6 lakhs. So in this case, 6 lakhs, 50,000 divided by 6 lakhs is not exceeding what? Is not exceeding what? It is not exceeding 10% of sum assured. Therefore, this policy is what? Exempt. The maturity of this policy is exempt because the premium does not exceed the threshold. Now, second policy, 40,000 and 3,50,000. So this 40 divided by 3,50,000 will be taxable because 40,000 divided by 3,50,000 is more than 10% of sum assured. Therefore, it will be taxable. I hope it is clear to all of you. Therefore, out of two, which is exempt? A is exempt. We have answered the first part of the MCQ. Now, let us go ahead with the second part of the MCQ. And what is the quantum of deduction which would be available under section 80C? How much deduction you will get under 80C in respect of premium paid on such policies for AY 22-23? Assume that Mr. Manoj does not have any other ULIP only, does not have any ULIP only for the purpose of answering this question. So for the purpose of answering this question, make an assumption that he does not have any ULIP, he has only these two policies. That's it. So we need to understand that how much deduction he will get under 80C. Under 80C also there is same provision, which I have said for exemption, that if your annual premium exceeds 10% of sum assured, then you will get the deduction up to 10% of sum assured. Up to 10% of sum assured you will get. And in excess amount you will not get. And if it is less than 10% of sum assured, then the entire amount you will get. So now let us talk about first policy. In case of first policy, that is policy A, is the annual premium exceeding 10% of sum assured? The answer is no. Therefore, this entire 50,000 will be allowed in 80C. In case of second assessee, in case of second policy, is it exceeding 10% of sum assured? The answer is yes. So in this case, you will get up to 10% deduction you will get. In excess amount, you will not get. Therefore, what will be the 10% of sum assured? The 10% of sum assured will be 35,000 rupees. Therefore, in this case, for policy A, you will get a deduction of 50,000 under 80C. And for policy B, you will get a deduction of 35,000 for policy B. And cumulatively, you will get deduction of 85,000. And therefore, the answer to first MCQ is D, D and D. How D? There are two questions which are asked in this particular question. First question is given in the first two lines. Next question is given in the next two lines. So first question is, which policy is exempt? We have already concluded. Only A is exempt. And second question in the same question is, the second part of the question is, how much will be the deduction allowed under 80C? So that is 85,000. 50,000 for policy A and 35,000 for policy B. I hope everyone is clear with this particular question. Is it clear? Shall I go ahead? Varsha, Shashank, Sachin, Shubham, Anjali, Miss Thomas, shall I go ahead? Please give me a confirmation. Now, question number 2. Let's go ahead. This is how we try to understand each and every reasoning of the MCQ. This will save you a lot of time. Otherwise, you will waste a lot of time in understanding the reasoning of each and every MCQ. Suppose you are stuck with some of the MCQs. You will waste around 1 or 2 hours in one of the MCQs. Then it is a lot of waste of time. You cannot waste so much time for 1 or 2 MCQs. So better you go through with me and you will be done with all the MCQs. Don't worry. Share this link with maximum of your friends, please. Give this benefit to maximum of your friends so that they can also take an advantage of this particular lecture. Anyways, question number 2. Which are the ULIPs in respect of which Mr. Manoj would be eligible for exemption under 1010D in respect of maturity proceed? Choose the option most beneficial to Mr. Manoj. Listen carefully now. This is a beautiful question. Now, for ULIP, there is an amendment made by Finance Act 2022. You might be knowing it. There is an amendment which is made by Finance Act 2021, sorry, not 22. 22 is not applicable for your exams. Actually, these days, batches of 2023 is going on. So, in my mind, always Finance Act 2022 comes. But for your exams in November 22, you will be tested only on Finance Act 2021, not 22. Okay. So, there is an amendment, very significant amendment made by Finance Act 2021. which talks about ULIP. What does it say? It says that if the ULIP is issued on or after 1st of Feb 2021, keep this date in your mind. If the ULIP is issued on or after 1st of Feb 2021, then if the assessee wants to claim an exemption, he has to fulfill two conditions. First condition, which was prevailing earlier also, that is the percentage criteria, that your annual premium should not exceed 10% of sum assured. That is the condition which the assessee has to fulfill. Assessee has to fulfill earlier also, and now also assessee has to fulfill. That is the first criteria which assessee has to fulfill. The second criteria is your annual premium, the aggregate annual premium of one or more policy should not exceed 2,50,000 rupees. If it exceeds 2,50,000 rupees, then you have to select two policies, three policies whose annual premium does not exceed 2,50,000 rupees. I hope you might be knowing this particular provision. So again, I am saying this provision. There is an amendment which has been made from 1st of Feb 2021, which says that if you want an exemption with respect to ULIP, you have to fulfill two conditions. First, you have to fulfill the criteria of percentage. Your annual premium should not exceed 10% of sum assured. And second, your annual premium should not exceed 2,50,000 rupees annually. And if there are more than one policy, then cumulatively it should not exceed 2,50,000. And if it exceeds 2,50,000, you have to select those policies whose premium does not exceed 250. So let us try to understand with this note, with this logic, with this provision, that which of the ULIPs are exempt and which are not. First of all, let me tell you, this ULIP is not covered in the amendment because this ULIP is issued prior to what? Prior to the date of amendment. The date of amendment is if it is issued on or after 1st of Feb 2021, and this is issued on 1st of Jan 2021, therefore this cannot be covered in amendment. So for this ULIP, ULIP D, you only have to fulfill one condition, that is the percentage criteria. And the percentage criteria is how much? It should not exceed 10% of sum assured. And your annual premium is 3 lakh, your sum assured is 30 lakhs. So it is exactly 10% of sum assured. Therefore, this policy is what? Exempt. Is everyone clear with this? This is by default exempt. Now you have to choose between C, E and F. So you have two options now. Either select C and E, because C and E cumulatively does not exceed what? 2,50,000, or select F. You cannot select C, E and F, because if you select C, E and F, then your cumulative annual premium will exceed how much? Will exceed 2,50,000. So I am selecting C and E. If I select C and E, my 10 lakh and 15 lakh, that is 25 lakh will be exempt. And my annual premium will also be not more than 2,50,000. And my percentage of premium is also exactly less than 10% or up to 10%. You can see. So I am selecting C and E. So if I select C and E, annual premium is 2,40,000, and my the sum received will be how much? Will be also 11 lakh and 17 lakhs, that is 28 lakhs. And sum assured is also 10 lakh and 15 lakh, that is 25 lakhs. Okay. So in this case, what shall I do? Listen carefully. So what, sir, why can't we select F instead of C and E? Don't select that. That would be not tax beneficial for you. Sir, how? How it won't be tax beneficial for me? Listen carefully. Let us make this taxable. And let us take an exemption for E and C. Why, sir? The question is asking us to say which is the most beneficial for Mr. Manoj. So I am telling you the most beneficial is C and E. So you will ask, in case of C and E, the total amount exempt is 11 plus 17, 28. In case of F also, the premium does not exceed 2,50,000 and the total amount is 28. So in both cases, the final amount is going to be 28 only. No, but it is better to make F as taxable, because F would be taxable under 45(1)(b). If it is taxable, if ULIP is taxable, it will be taxable under 45(1)(b). And in 45(1)(b), what is the treatment? The sale consideration of 28 lakhs will be compared with the premium paid by the assessee. So it is better that the ULIP which you are making as taxable, for that the higher premium would be better for you, because then in that case the gain will be lesser. Because if I consider F as exempt and if I consider C and E as taxable, then the cumulative premium of C and E will be lesser. So in that case, my gain will come to a higher amount. Did you understand what I am trying to say? Please respond. So it is better to tax that ULIP which has a higher premium as compared to that ULIP which has a lower premium. Good evening, Jyoti. Are you clear? Are you clear? Please let me know. I want a response from you all. Please. I want a response from you all. Correct. Therefore, it is better what you do. You take C and E as exempt, D is anyways exempt. So the answer would be what? C, D and E would be exempt. Is it clear to everyone? So answer to second question is C, D and E would be exempt. D is anyways exempt because for D amendment is not applicable. Only percentage has to be checked. C and E better because the ultimate maturity amount with F, if you compare it, is 28 lakhs only, and it is better to make exempt those ULIPs whose premium is lesser, because higher premium ULIP should be made taxable, because in that case your gain will be lesser. I hope it is clear to all of you. Okay. Now question number 3. Consider, now this is a very simple question. Considering the option chosen in MCQ 2 above, what would be the capital gains computed under 45(1)(b) in the hands of Mr. Manoj for AY 31-32? Assume that for the purpose of this MCQ, no consideration was received prior to what? Prior to maturity date in case of any ULIP. Now, in case of what we have made taxable, we have made this particular ULIP as taxable, right? So how it will be taxed now? As I have told you, sale consideration is 28 lakhs, okay? Minus premium. Minus premium of how many years? Now, premium will start from this year and will end in this year. And what is the annual premium? Annual premium is 2,50,000. So let us count how many years it comes to. 21-22 1 year, 22-23, 23-24, 24-25, 25-26, 26-27, 27-28, 29, 28-29, 29-30. Total 9 years are there. So you will multiply 2.5 lakhs into how many years? 9 years. So this will come to 22.5 lakhs. Okay. So your cost will be 22.5 lakhs. Your sale consideration is 28 lakhs. Therefore, the differential amount will be taxable as capital gains under section 45(1)(b) as per the new amendment. So as per section 45(1)(b), the difference amount will be taxable as what? Will be taxable as capital gains. And it will be taxable as capital gains under which section? 45(1)(b). And it will be taxed at what rate? It will be taxed at 10% under section 112A. This is also an amendment made by Finance Act 2021. Do you remember that? This is also an amendment made by Finance Act 2021. Do you remember that? Please let me know. Please let me know. So how it has come to? Sale consideration minus premium paid. The differential amount will be taxed without indexation. In 112A, you do not get indexation. I hope you know that. So this is an amendment made by Finance Act 2021. Okay. Clear? Question number 4. Let us talk about this question now. What is Mr. Manoj's tax liability for AY 22-20? Now there is one mistake in this question. What is the mistake in this question? This should have been AY 30-31 because the amount is received in PY 29-30. Check. So if the amount is received in PY 29-30, how it can be an income of AY 31-32? It has to be an income of AY 30-31, right? Now this is a mistake by ICAI. But anyways, nevertheless, let us go ahead. Question number 4. Okay. What is Mr. Manoj's tax liability? Now let us see what all things Mr. Manoj has. Beautiful question. The first thing which Mr. Manoj has is dividend income of 12 lakh from shares of Indian company. This will be taxable at slab rates. Taxable at slab rates. Now what is the second thing that Mr. Manoj has? LTCG, long-term capital gains on sale of land. This is the second thing which Mr. Manoj has. LTCG on land. This is the second thing which Mr. Manoj has. This will be taxable at 20%. LTCG on land is taxable at 20% under section 112. And this 12 lakhs will be taxable at what? It will be taxable at slab rates. Then Mr. Manoj has also invested in NPS. This will be subject to deduction under 80 CCD subsection 1. Okay. Subject to a limit of 1.5 lakhs. 80 CCD subsection 1. Be very careful. Beautiful question it is. Okay. 80 CCD subsection 1. Subject to 1.5 lakhs and also subject to 20% of GTI because he is a self-employed. If he would have been a salaried assessee, then it would have been 10% of salary. But in case of self-employed assessee, it is 20% of GTI, gross total income. We'll talk about that in a while. Okay. Now pay attention, please. Let us compute his income. Apart from this, do you feel that there is any other income that will come to his total income? Dividend will come. Long-term capital gains on sale of land will come. These are the two incomes which are very obvious. You can see on the board itself. But is there any other thing that will come in the current year? The answer is yes. What is the next thing which will come? It is the maturity of this particular ULIP, ULIP B. Not ULIP, sorry, LIC. So LIC is also charged like that only. That amount received by the assessee minus the amount paid as a premium. The differential amount will be chargeable under the head IFOS. The ULIP transactions are chargeable under, because ULIP is a unit. So ULIP transactions are chargeable as capital gains on maturity. But normal insurance policy is not chargeable as capital gains. It is chargeable as IFOS. So what will be the IFOS? The differential amount, the amount received on maturity, how much it is? The amount received on maturity is 4 lakh and the amount paid as premium is 40,000 rupees per annum. And the assessee is paying for premium for how many years? 15, 16, 16, 17, 17, 18, 18, 19, 19, 20, 21, 20, 21 and 21, 22. Because it is matured in 22. So the assessee has paid that 40,000 premium for how many years? For 7 years. And therefore, in this particular case, the premium paid by assessee in totality would be 40,000 into 7, which will be 2,80,000 rupees. And how much assessee is receiving on maturity? 4 lakh. So the differential amount of 1,20,000 will be IFOS. So I have got the GTI now. The GTI is as follows. Dividend will be 12 lakhs. Is it clear? That is directly given in the question. LTCG 5 lakh directly given in the question. But LIC maturity, which will be taxable as IFOS income. ULIP maturity is taxable as capital gain because that is based on units. That is like mutual fund units. This is not units. This is like FD. So 4 lakh minus 7 lakh premium. 1 lakh 20, 18 lakh 20 is your GTI. Now he will get a deduction. How much deduction? First of all, he will get a deduction of LIC and ULIP. What? We have already concluded that for ULIP he will get deduction of 85,000. We have already concluded that earlier in question number 1, right? Now apart from that, he will also get deduction of this, deduction of this, deduction of this, deduction. These are also allowed as deduction under ATC. All of them are allowed. Even contribution of annual premium for ULIP is allowed as deduction under ATC if the annual premium does not exceed 10% of sum assured. In none of the cases the annual premium is exceeding 10% of sum assured. Therefore, the LIC and the ULIP itself is exhausting the entire 1,50,000 rupees. So 1,50,000 is getting exhausted because of what? ATC, LIC and ULIP itself. And you might be knowing 80C plus 80 triple C and 80 CCD subsection 1. If you take together all three of them, then you get a deduction of 1,50,000. But unfortunately, your only one particular policy, that is ULIP and LIC itself, is completing the target of 1,50,000 rupees. So now 80 CCD subsection 1, which is around 20% of GTI, your GTI is 18,20,000. 20% of that will come to 3,64,000. This is of no use to us because in 80C it is already covered 1,50,000. But don't worry, in 80 CCD subsection 1B, you can get balance 50,000 as deduction. Whatever amount is unallowed in 80 CCD subsection 1, it can be allowed in 1B subject to 50,000. Now in my case, the entire 3,64,000 is unallowed. Do you agree or not? Therefore, the entire 3,64,000 is eligible for 80 CCD subsection 1B. But in 1B, there is a target, there is a limit that you will get only 50,000. So the total chapter 6A deduction would be how much? 1,50,000 in 80C and 80 CCD subsection 1B, 50,000 rupees. And what about subsection 1? You cannot get anything because the limit of 1,50,000 is already exhausted by 80C. So subsection 1 is gone. So, but 1B is over and above 150. Please go and read properly. 1B is over and above 1,50,000 rupees. Because in 1,50,000 what comes, you know? In 1,50,000 only 80C comes, 80 triple C comes, and 80 CCD subsection 1 comes. Subsection 2 also doesn't come, where employer makes a contribution. And even 1B doesn't come, where 50,000 extra you get the deduction. I hope it is clear to all of you. So with all this thing, you will get the total income as 16,20,000. Now out of this 16,20,000, 5 lakh is LTCG. Therefore, LTCG will be subject to 20% tax. This will be 1 lakh, and balance 11,20,000 will be subject to slab rates. The assessee is not following what? 115 BAC. Then you will apply the normal slab rates. You will not apply the alternate tax rates. So the tax over here comes to slab rates 1,48,500. Therefore, 1 lakh plus 148,500 comes to 248,500. You apply 4% cess on that, and you will get the answer as 258,440. And this is the answer which is there for this particular question. Please reply. Is it clear to every one of you? Please reply. And last but not least, question number 5 is a very straightforward question. What would be the tax deductible under 194DA during the previous year 21-22 on payment of maturity of life insurance policies to Mr. Manoj? Now, what does 194DA says that? 194GA says that if the LIC is taxable in the hands of the assessee, then deduct TDS. Now you are receiving which ULIP capital gains? ULIP capital gains is not considered in total income because ULIP capital gains is happening in future, Sachin. ULIP capital gains are not happening in current year. What is happening in current year is only the normal insurance policies. Is it clear, Sachin? We have not considered ULIP capital gains over here because that is happening in 2030, not in 21-22, beta. Clear? And you are making calculation for AY 22-23, not for 2030. All the ULIPs are maturing in future. I hope it is clear to you. Now, in 194DA, the TDS section says what? If your LIC is taxable, not exempt. If it is exempt, don't deduct TDS. If it is taxable, deduct TDS at the rate of 5% on the difference amount. 5% of which difference amount? Same difference amount. Amount paid to the assessee minus premium paid by the assessee. So what is the amount paid to the assessee? 4 lakhs. You can see in case of policy B, because policy A is exempt. Because policy A is exempt, there is no requirement to deduct TDS. But in case of policy B, it is taxable. You have to deduct TDS. And therefore, in this case, how much TDS will be deducted? 40,000 into 7 will be the premium paid. That is 2,80,000. This will be the amount received. Differential amount 1,20,000, 5% TDS. Check over here. 5% TDS on 1,20,000. This will come to 6,000 rupees. Is everyone clear with the first MCQ? Please let me know so that I can go ahead with the second one. Please let me know. I hope it is clear to all of you. So I am moving ahead with the second one. I am reading the second question once and for all, first of all, and then I'll be reading the MCQs one by one. Okay. Case scenario 2. EduAid is a charitable trust. Thank you, Priyanka. Thank you, Pritesh. Thank you, Anjali. Thank you, Varsha. Thank you, Sachin. Thank you, Pratap. Thank you, Chirag, for joining this session. I hope you all are enjoying. Henceforth, whatever I'll be doing in Hindi, I will try my best that I'll be doing in English also for you all. Whatever, and I hope you all are enjoying the revision videos as well. I'll try to upload the next one as soon as possible. Next one will be on capital gains. Okay, let's read the case scenario 2. Thank you, Shrikant. EduAid is a charitable trust registered under Section 12AB. Its main object is education for economically weaker section of the society during the previous year 21-22. It received 60 lakhs as voluntary contribution and 12 lakhs as anonymous donation. The trust borrowed 50 lakhs on 1/5/2021 from SBI for construction of a primary school in a village in Tambaram near Chennai. Coming to your location now. The trust repaid principal of 10 lakhs to SBI on 31st of March 2022. The trust incurred expenditure of rupees 1 lakh on purchase of books for library and 10 lakh on purchase of computer for junior computer labs. The other applications which are revenue in nature is 7 lakhs. This sum includes 30,000 paid in cash for repair work to Mr. Rajesh and 80,000 paid towards fees for professional services on 15 June. Without deduction of tax at source, the excess application by the trust in previous year 2021 is 4 lakh rupees. The trust also received 25 lakh by way of corpus donation for construction of Arts College in Avadi, Tamil Nadu during the previous year 21-22, out of which it deposited 12 lakhs in the post office saving bank account in January 22. The balance in post office saving bank account after such deposit is 22 lakhs and invested 8 lakhs in shares of a public sector company in October 2021. However, in March 2022, due to disinvestment by the government, the company ceased to be a public sector company. The trust also withdrew 5 lakhs from post office saving bank account in March 22 and applied the same for construction of the primary school in a village in Tambaram. During the year 21-22, the trust spent 72 lakh in total for construction of the said school. The trust has donated to poor aid another trust registered under 12AB 5 lakhs out of its current year income and 4 lakh out of its accumulated income. Out of the amount of 5 lakh donated out of its current year income, 2 lakh was towards the corpus of poor aid. So this is a beautiful question once again. Let us try to understand all the MCQs one by one. The first one now. What is the quantum of donation taxable at the rate of 30% under section 115 BBC? What is 115 BBC? 115 BBC talks about anonymous donation. Now, how much anonymous donation is taxable under income tax law? The anonymous donation which is taxable under income tax law. First of all, how much is anonymous donation in this question? The anonymous donation which is there in this question is 12 lakh rupees. Now, how much is taxable out of this? Listen carefully. What does section 115 BBC says? 115 BBC says that the anonymous donation which is taxable is 12 lakhs minus 1 lakh or 5% of total donation. So out of 12 lakhs, you have to reduce 1 lakh or 5% of total donation, whichever is higher. Whichever is higher. So 1 lakh or 5% of total donation, whichever is higher, will be reduced. Now, what is total donation in this question? The total donation in this question is 60 lakhs you have received as voluntary donation and 12 lakhs as anonymous donation. Now, maximum students will make a mistake over here. They will say that the total donation is 60 plus 12, that is 72. And if you take a 5% of 72, that is one of the answer given in the question. You can see that. That is one of the answer given in the question. But that is wrong. The correct answer would be 60 lakhs plus 12 lakhs and there is 25 lakhs more you have received by the form of corpus donation. So the total donation received by you is 97 lakhs and you will get 5% out of that. So if you get 5% out of 97 lakhs, so 5% of 97 lakhs comes to how much? 7.15. And this is the correct answer. Sorry, this comes to 4,85,000 rupees. And if you take 4,85,000 rupees, you reduce 4,80,000 from 12 lakh rupees, you will get 7,15,000 and that is the correct answer. I am trying to say that when you take a total donation, you have to take total of everything. That is 12 lakh and 60 lakhs and 25 lakhs as well. Is everyone clear with the first question? Please let me know. Is everyone clear with the first question? Please let me know so that I can move ahead towards the next one. Question number 7. Can the amount donated to poor aid be allowed as application in the hands of the Edu8 in the previous year 21-22? If so, how much? Let us talk about, they are giving some donation and now let us talk about how much donation will be allowed out of it. The discussion of donation is given here. The trust has donated to poor aid, another trust registered under 12AB 5 lakhs. 5 lakh is donated out of current year's income and 4 lakh is donated out of its accumulated income. Let me tell you first of all, the amount donated out of accumulated income of last year is not allowed as application. It means you have to donate from the current year's income if you want a deduction. If you want a deduction for trust, you have to donate from the current year's income, not from the accumulated income of last year. So this is out of question now. Now, 5 lakh is donated out of current year income. That might be allowed, but subject to few more things which I have to read properly now. Now, out of 5 lakhs, out of its current year income, 2 lakh was donated towards what? Corpus of poor aid. Now, listen carefully. There is an amendment made by Finance Act 2019 or 20, either of the 2 years. I guess it is 19, that if you give a donation as corpus donation, it is not allowed as deduction in the hands of the donor. It is disallowed. So there are two things which are not allowed over here. First of all, donation given out of the last year's accumulated income, not allowed completely. And out of the current year's income, if you give a corpus donation, that is also not allowed. So out of 5 lakhs, 2 lakh is not allowed. So ultimately, how much is allowed? Only 3 lakh is allowed. And therefore, the answer to this question is D, which is 3 lakh rupees. I hope it is clear to everyone. Is it? Okay. Now the third question, question number 8, is based on the amendment made by Finance Act 2021. Now what is the amendment made by Finance Act 2021? The amendment made by Finance Act 2021 is as follows. Listen carefully. Before Finance Act 2021, a corpus donation received by an assessee was fully exempt. Was fully exempt. If I receive a corpus donation, it is fully exempt in the hands of the trust. But Finance Act 2021 has put some conditions for exemptions. Now, what are the conditions for exemption? Finance Act 2021 has said that now if you receive a corpus donation, it will be exempt only if you invest that corpus donation in the mode specified in 11 subsection 5. So, if you invest in the mode specified in 11 subsection 5, then only claim that as an exemption, otherwise it will be taxable. So, let us see whether the assessee has invested that or not. Question number 3 talks about what? Can the corpus donation received by EduAid be claimed as exemption under 11(1)(d)? If so, how much will be exempt? So now how much donation the assessee is receiving? Let us talk about that one by one over here. The assessee is receiving 25 lakhs by way of corpus donation for construction of Arts College in Avadi, Tamil Nadu. During the previous year 21, out of which deposited 12 lakhs in post office saving bank account in Jan 22. Sir, is post office saving bank covered in specified mode? Yes, it is covered. If you go and see the mode under 11 subsection 5, you will get post office saving bank. So this much amount of donation will be exempt out of 25 lakhs till now. In bracket, some other information is given that the total balance of post office is 22 lakhs. That is not relevant for me. This is just an information that the assessee might have made some investment in last year. So now the accumulated post office balance is 22 lakhs. It's of no use to me. Secondly, assessee has invested 8 lakhs in the shares of public sector company. Sir, is the shares of the public sector company covered in 11.5? The answer is yes. Go and see the list of 11.5. So therefore, the assessee has invested out of 25 lakhs, 20 lakhs in the mode specified in 11.5. Therefore, out of 25 lakhs, 20 lakhs is directly exempt in the hands of the assessee. Okay. So this will be exempt. So the answer to this question is what? Is 20 lakh. I hope it is clear to everyone. I have put the reasoning also of each and every answer over here. You can see on the right hand side there is a reasoning for each and everything. Exempt to the extent of modes deposited in specified in 11 subsection 5. I hope it is clear to all of you. Okay. Now question number 9. This is a very good question. This is again based on an amendment made by Finance Act 2021. I will tell you the amendment also, don't worry. Now what is the quantum of amount spent on construction which can be treated as application in the hands of EduAid? Now the trust has made a total construction cost of, the trust has incurred a total construction cost of 72 lakhs. Pay attention over here. So we need to identify how much will be considered as. This is the total expenditure earned by the trust. We need to identify out of this how much will be allowed as application. So first of all, let me tell you one amendment made by Finance Act 2021. What does this amendment has to say? Listen carefully. That will have an implication in this question. The amendment says that if you borrow a loan and if you do some expenditure with that loan, then that expenditure is not considered as an application. So if you borrow a loan and do a expenditure, that is not considered as an application, but it will be considered as an application only when you repay that loan to the bank. So while you take the loan and incur for the purpose of trust, it is not allowed as deduction. But when you repay the loan, then that is allowed. So you can see over here, the trust in the above line has borrowed 50 lakh rupees from SBI. Can you see this? For construction of primary school. So if you borrow 50 lakhs and use that for the purpose of construction of primary school, not allowed. What is relevant now is how much is repaid out of it. So only 10 lakh is repaid out of it. It means 40 lakh is not allowed. Only 10 lakh is allowed out of 50 lakhs. So let us make a bifurcation. The total construction cost made by the assessee is 72 lakhs. Do you agree to this? As it is written in the question, out of which 50 lakh is incurred through loan, but out of that loan only 10 lakh is repaid. Therefore only 10 lakh will be allowed out of 50 lakhs. Is everyone clear with this? Only 10 lakh will be allowed out of that 50 lakhs. Is it clear with you? So for 50 lakhs, I have given you explanation. 72 lakhs is the total construction cost for which you have taken a loan of 50 lakhs. You might have incurred entire 50 lakhs. It is of no use unless and until you repay that loan. So repayment is only to the extent of 10 lakhs. So that 10 lakhs will be allowed as deduction, will be allowed as application. Remaining 40 lakhs will not be allowed. It will be allowed in the year in which you make an application in the form of what? Repayment of loan. Whenever you will repay the loan, it will be allowed in that year. I hope it is clear to you. Now what is left? Left is 22 lakhs. 22 lakhs is left. Now what has to be done with this 22 lakhs? Let us try to understand that. Now you see over here, the trust has raised 25 lakhs by way of corpus donation. Now corpus donation is exempt and the trust has invested that corpus donation in post office, so that post office amount is also exempt. Now what the trust is doing? The trust is withdrawing 5 lakh rupees from public sector company shares. Sorry, the trust is withdrawing 5 lakh rupees from post office saving bank account in 2022. Now what? And it is applied for construction of primary school. Listen carefully, this point is very critical. First of all, you received 25 lakhs, you invested 12 lakhs in post office saving bank, so that 12 lakhs is exempt. Clear? So now you are withdrawing that 12 lakhs out of, you are withdrawing 5 lakh out of that exempt income and you are incurring an expenditure for the same. So what you are doing indirectly, you are withdrawing money from exempt income because that 12 lakhs is exempt, which is there in the post office, right? The amount received in the form of corpus and invested in the post office is exempt. So you are now removing an exempt income and incurring a construction cost on that. That is not allowed under the trust by the amendment made by Finance Act 2021, because you are withdrawing that money from an exempt source and incurring for the purpose of trust, not allowed as deduction. Therefore, out of the remaining 22 lakhs, this 5 lakh will not be allowed. Therefore, 17 lakh will be allowed. This 5 lakh will not be allowed because this 5 lakh is incurred from the exempt source of income, which is in the form of deposits in the post office. Therefore, this is not allowed as deduction, and therefore the total amount which will be allowed as deduction over here will be 10 lakh and 17 lakh, and the answer is 27 lakhs. So how this 27? Beautiful question it is. It's not that easy to decode this. It's a beautiful question. It's not that easy to decode. Let me tell you very clearly, some intelligent questions have been made by the ICI in this particular RTP. Anyways, I'm moving ahead towards the last question of the MCQ case scenario, and then I'll move ahead towards the individual MCQs. What is the total amount which can be treated as application? What is the total amount which can be treated as application in the hands of edu aid in previous year 21-22, excluding unconditional accumulation of 15%? Now, this is a very simple question. There are some of the points which we have already discussed. Like, we need to understand the total amount allowed as application to the trust. It means the total deduction allowed to the trust. Pay attention. First is something which we have done earlier. Can I say this is done earlier and this is done earlier in the previous MCQs? The construction cost of 27 lakh will be allowed as deduction, and the donation given to another trust will be allowed to the extent of 3 lakh rupees. So this is something which we have already done. Right? And this is very simple. The trust has purchased a computer of 10 lakh and library book of 1 lakh. So that will be allowed as application of income. You can see over here, computer of 10 lakh and library books of 1 lakh. Can I say this is also very, very simple? So 4 items are done. Now there is only 1 item which is pending. That is, the trust has incurred a revenue expenditure of 7 lakh. But out of that, the trust has paid 30,000 in cash. So is the provision of PGBP of section 40A subsection 3 applicable to trust also? The answer is yes. There are two PGBP provisions which are applicable to trust also. First is the disallowance of TDS paid to residents. If you make a payment to resident, do not deduct TDS, do not pay TDS, then that 30% is disallowed. That provision is also applicable to trust. And second one is cash payment in excess of 10,000 to any party, and you are claiming an expenditure for the same, that is also disallowed. So there are two expenditures which are disallowed for the trust. So the trust is doing both of them. First of all, this 30,000 will not be allowed. I am putting a cross. So how much will be allowed now? Out of 7 lakh, remove 30. So remaining is 6,70,000. Now this 80,000 is paid for some professional fees without deducting TDS. So out of this 80,000 also you have to disallow 30%. So 30% of 80,000 will come to 24,000. So 24,000 this will also be disallowed. So out of 7 lakh, first of all 30k is not allowed because it is paid in cash, and 24k is not allowed because it is disallowed because of non-deduction of TDS. So how much is allowed? 6.46 will be allowed. If you remove these two amounts from 7 lakh, you will get 6.46, and that is the final amount which is pending over here. If you make a total of all of them, you will get the answer as 47.46, and that is the correct answer. Is everyone clear with this second case scenario MCQ? Please tell. Are you clear? Are you clear? So that I can move ahead with the individual MCQs now. Okay, I am moving ahead with question number 11. Okay, there are so many people who are online, but they are not answering. They are all Lord Governors. They don't want to answer. They don't want to reply. Please reply. That will encourage me to some extent. Anyways, my energy is too high always. I don't need anybody's encouragement in my life. I can speak without students also in front of the camera. But still, if you will encourage me a little bit, that will be icing on the cake for me also. Okay, anyways, it's okay, no issues. So, question number 11. ABC Limited, an Indian company, purchases coal. Coal is a very important product under income tax law from XYZ Limited and another Indian company for 60 lakh rupees during the previous year 21-22 to manufacture steel. Now, there is a buyer over here. There is a seller over here. What is the seller selling? The seller is selling coal. Do you know that if a seller sells coal, then he has to collect TCS? Coal is subject to TCS under section 206C subsection 1. But there is a relaxation which says that if the buyer gives an undertaking that he will use this coal for manufacturing and not trading, he will not trade this coal. He will use this coal for manufacturing of any article or thing, or he will use this coal for the purpose of generation of power, then the TCS provisions are not applicable. Not applicable. So in this case, the assessee is giving an undertaking. Check the question properly. ABC Limited, that is the buyer, furnishes a declaration that such coal is used to manufacture steel and not for trading. Therefore, the seller will not collect TCS. The seller will also not collect TCS in 206C1H, which is a very recent section introduced by Finance Act 2020. He will not collect TCS under this section also. Why? Because a product which is covered in this section will not be subject to TCS under 1H. In 1H, certain products are out of the question. First, if a product is exported outside of India, no TCS. If a product is covered in 206C1 or 1F or 1G, then no TCS under 1H. So the seller is relaxed from all his obligation of deducting TDS. Seller is not liable to deduct TDS, not liable to collect TCS under the main section of 206C subsection 1, nor in 1H. Why not in 1? Because of the relaxation, because the buyer is using the goods for what? For the purpose of what? For the purpose of production or manufacturing. So no TCS. Why not in 1H? Because the goods which are covered in 1 will not be covered in 1H. So TCS is out of question. But in this case, CBDT has issued a recent circular. You can refer the latest statutory update issued by the ICAI for November 22 exam. In this case, if the buyer's turnover, if the buyer's last year's business turnover is greater than 10 crore, then the buyer is liable to deduct TDS under 194Q at the rate of 0.1% in excess of 50 lakh rupees. I hope you might be knowing this new section. I hope you might be knowing this new section. So seller is not obligated to collect TCS, but in such cases, the buyer is not relaxed. The buyer's turnover of last year, business turnover of last year is more than 10 crore. The buyer is liable to deduct TDS under 194Q on an amount in excess of 50 lakhs. So the purchase is 60 lakhs. So the buyer will deduct TDS at the rate of 0.1% on excess amount, that is on 10 lakh rupees. Check. So in this case, the answer is C. No TCS, no TCS, no TCS. But yes TDS, yes TDS, yes TDS under 194Q on 10 lakh at the rate of 0.1% by the buyer. For knowing this particular provision, you need to refer the latest circular issued by CBDT in your statutory update booklet. Is it clear to all of you, sir? Shall I go ahead? Shall I go ahead? Please let me know. Shall I go ahead? So, question number 12. A survey is conducted under 133A in the premise of Mr. Aarav. Okay. And the search is conducted under 132 in the premise of his friend Mr. Arjun. So Aarav is subject to survey and Arjun is subject to search. The AO after that issued notice under 148 for AY 1920, 2021, 2122 to Mr. Aarav and Arjun. So once survey and search is done, the AO issued notice under 148 requiring both the assessees to file return. Under 148, he will send you a notice and then you have to file the return. However, such notices were not accompanied by the copy of an order passed under 148A. What is 148A? You might be knowing that before issuing a notice under 148 requiring the assessee to file the return, the AO is supposed to conduct an inquiry. So he has not done an inquiry, he has directly sent the notice. Can he do so? That is the question. So listen carefully. For that, you need to read the provision inside out. Look at the kind of detailing the ICI has done in this question. If you have read properly the provision, you might be knowing. Let me tell you the provision. In case of survey, there is a need to do an inquiry under 148A. In case of survey, there is a need to do an inquiry under 148A. But in case of search, there is no need to do any kind of inquiry as it is written in an explanation to section 148A. You can check an explanation to 148A. In explanation to 148A, it is written that for survey, there is no need to do any kind of inquiry. Sorry, for survey, there is a need to do an inquiry. But for search, there is no need to do any kind of inquiry. So in this case, on Mr. Aarav, there is a survey. So in that case, he should have sent a copy of order. There is a need to do an inquiry before sending a notice under 148. But in case of Mr. Arjun, there is no need to do any kind of inquiry. Directly 148 notice can be issued. You can go and read an explanation to section 148A, which says that in the following cases, there is no need to do any kind of inquiry. In that, one of the cases is search and survey is not mentioned in that. So in case of survey, there is a need for an inquiry. And therefore, the answer to this question is point number C. Yes, the action of the AO in issuing notice under section 148 is valid in the case of Arjun, but not in the case of Aarav, because in case of Aarav, the department should have passed an order under 148A and done an inquiry, because in case of Aarav, there is a survey, and in case of survey, you have to conduct an inquiry. That is a precondition to issue notice under 148. Is it clear to all of you? I hope it is clear to all of you. Yes. Let's go ahead with the next question. Question number 13. The EBITDA of Ganga Limited, an Indian company, for financial year 21-22 is 800 lakhs. The EBITDA is 800. It paid interest of 440 lakhs to Andes Inc. Brazil, which is a specified foreign company. Now, who is a specified foreign company? A specified foreign company is a company in which Indian company holds 26% or more voting power. So if an Indian company is holding 26% or more voting power, that company becomes specified foreign company, and in that case, that company will be called as what? Deemed to be my associate enterprise, because for associate enterprise also there is need of only 26% shareholding. Only 26% voting power is required. So where is the definition of specified foreign company? It is mentioned in 115 BBD. 115 BBD. You can check that section where if you receive a dividend from a specified foreign company, that dividend is taxable at the rate of 15% without any deductions or allowances. So the one thing is very clear that Ganga Limited, an Indian company, and Andes Inc., a Brazilian company, are associated enterprise. If they are associated enterprise, transfer pricing is applicable. Now, how much interest I am paying? 440 lakhs. Now, what is the arm's length interest? As per CUP method, arm's length interest is 350. I am paying 440. Arm's length interest is 350. Therefore, the differential amount will be added back 90 lakhs. This will be called as primary adjustment. Now, because the primary adjustment is not exceeding 1 crore rupees, therefore, the secondary adjustment is not possible. Because secondary adjustment is possible only if the primary adjustment is more than 1 crore. So, in this question, secondary adjustment is out of question. What is relevant is only the primary adjustment. Primary adjustment will be done of 90 lakhs. What is secondary adjustment? Deemed loan, interest on that deemed loan, unless and until that money is repatriated back to India under 92C, all those provisions are given. Okay. So 90 lakhs primary adjustment, secondary adjustment will not be done. Now what about the limitation of interest? 94B will apply. Why it will apply? Because you have taken a loan from a non-resident associate enterprise and you are paying interest to them. So now you have to compare with what? Point number 1 interest, point number 2 whichever is lower will be disallowed. What is point number 1, sir? Point number 1 is interest paid minus interest paid to total interest paid minus 30% of EBITDA. And point number 2 is interest paid or payable to associate enterprise. Now in this you have to be very careful. You only have to take the allowable interest. You do not take 440 lakhs. Because if you start to take 440 lakhs, then you will start to make double disallowances over here, because already the difference between 440 and 350 is added in the form of primary adjustment. You cannot disallow that 90 lakhs again in the form of 94B. So here you only have to take the allowable interest. So interest paid, total interest paid minus 30% of EBITDA. EBITDA is 800, 30% of that comes to 240. Therefore, the point number 1 will come to 110. And point number 2 will be the interest paid or payable to associate enterprise. That will be again only that interest which is allowable as deduction, not 440, because then you will again disallow for 90 rupees. Do not disallow 90 again. Therefore, you will only take the interest allowable in this case. And how much is the interest allowable? 350. Why I am not taking 450, 440? Did you understand? Don't take 440. It will be double disallowance of the same interest once again. While computing 94B limitation of interest, you have to take the allowable interest. In our class, whenever I do a question, I teach that to the students. Okay. So what is the ultimate conclusion? Whether there will be a primary adjustment? No. Sorry, whether there will be a secondary adjustment? No. Because the primary adjustment is not exceeding 1 crore. Whether there will be a limitation of interest? The answer is yes. Because for limitation of interest, also there is a threshold of 1 crore. And in this case, you are paying an interest of 3.5 crore rupees, that is 350 lakhs. Therefore, limitation of interest provision is applicable. So in secondary adjustment, you have to see the threshold of primary adjustment, which is less than 1 crore. But in limitation of interest, you have to see the interest allowed to you. If that is more than 1 crore, limitation of interest is applicable. Interest allowed to you is 350 lakhs. Therefore, limitation of interest 94B will be applicable. Okay. So ultimate conclusion will be this. 94B will be applicable, 110 lakh disallow, and secondary adjustment will not be made to the assessee. Okay. I hope it is clear to all of you. The next one, it's a big one. It's not a question on MCQ. It's a proper descriptive question, in fact. How the hell institute can ask such a big question in MCQ? It will take around 15 minutes to solve this question. It's a proper question on slum sale and the amendment made by Finance Act 2021, where you have to now identify the sale consideration in the prescribed manner as per Rule 11 UAE, which says that FMV1 or FMV2, whichever is higher. So entire provision is applicable in this particular question. Let us read the question first of all. Message ABC Limited has 2 units. Unit A, Unit B, both of which commence operations on 1/4/2015. It sold Unit B on slum sale on 1/7/2021 for 1.45 CR. Unit B is engaged in the specified business. Very important line. What is Unit B doing? Specified business under 35 AD. Operating a warehouse for storage of sugar. So 35 AD associates. Now, the assets of Unit B are as follows. These are the value as per books of accounts. These are stamp duty values of certain assets like land and building as on the date of slum sale. Okay. So now what is slum sale? How slum sale is computed? Slum sale is computed like sale consideration minus cost of acquisition. What is sale consideration? For that, there is a rule now. FMV1 or FMV2, whichever is higher. What is cost of acquisition? That is net worth of the unit transferred. So the first thing which I am trying to identify over here is the cost. Let us try to understand the cost. How to identify the cost? The net worth. The net worth is nothing but the cost of acquisition of the slum sale. So in that case, you have to take all the assets minus all the liabilities. Liabilities will be taken at book value. So I am taking the book value of these two liabilities over here as 20 lakhs. Debtors will be taken at book value. So I am taking the book value of the debtors. Okay. Building I am taking nil because it is written in the net worth definition that if an asset is already claimed as deduction under 35 AD, then the net worth, in the net worth you have to take the value of that asset as nil. Even the value of self-generated goodwill has to be taken as nil. And even the value of 35 AD assets, because the assessee has claimed deduction under 35 AD. So the value of building which is allowed as deduction under 35 AD, land is not allowed as deduction under 35 AD. But building is allowed as deduction under 35 AD. Plant and machinery is allowed, furniture is allowed, land is not allowed. So because the building is taken as deduction, this will be subject to what? Nil. It will not be allowed as deduction. And what about land? Land will be taken at an amount which is other than revaluation, excluding revaluation. So 80 lakh is the value of land. Reduce 6 lakhs as revaluation, take 74 lakh as land value. So the land will be 74 lakh excluding revaluation, building nil because you have already claimed deduction under 35 AD. Net worth says that the value of such asset on which you have claimed deduction under 35 AD shall be taken as nil. And debtors will be taken as what? Book value. And liability will be taken as book value. So the cost of acquisition is 66 lakhs. Now what is the sale consideration? Sale consideration is FMV1 or FMV2, whichever is higher. Now what is FMV1? FMV1 is this, FMV2 is this. How is FMV1 computed? A plus B plus C plus D minus L. What is A? What is B? What is C? What is D? Let me go from backward. And what is L? L is liability, book value of all liabilities. So book value of all liabilities 20 lakhs. So I am taking L as 20 lakhs. Now we are computing sale consideration. What is D? D is the stamp duty value of the immobile property. So the stamp duty, there are two immobile properties. Now what does FMV1 consider of? FMV1 considers of the assets which you have transferred to the other person. So whatever assets I have transferred to the other person, that is the seller has transferred to the other person, the FMV of that asset will be considered in FMV1. And what will come in FMV2? In FMV2, two things will come. The money received from the other person, and if there is some non-monetary consideration received by you, then the FMV of that particular asset received from you, from the person, that is from the buyer, that will be considered in FMV2. I am again repeating. FMV1 and FMV2 is exactly opposite of each other. FMV1 talks about what you have given, take an FMV of that. And FMV2 talks about what you have received. You might receive either money or non-monetary consideration. So you have to take money plus FMV of non-monetary consideration in FMV2. So let us talk about FMV1 now. FMV1 is A plus B plus C plus D minus L. You might have studied all these things in your syllabus, yeah, from whichever professor you have done. I have not taught, obviously, because if you have learned in 100% English, I have not done an English batch so far. But for your kind information, from 21st of August of this month, I am starting with a full English batch, regular batch for May 23 students, November 23 students. If any of your friends wants to enroll for that, please tell them that they can enroll. That it will be a live virtual batch, and later on, if they want recordings, so the recordings would also be available in Google Drive and Pen Drive. Okay, you can tell them to contact my official number. Okay, that is 900-900-8977. Anyways, coming to A plus B plus C plus D. What is L minus L? L is liability. Take the liability as 20 lakhs. What is D is the stamp duty value of all the immobile property. That is 95 lakhs and 60 lakhs is the stamp duty value of the two immobile property. What is C? C is missing in this question. That is unlisted shares. Are we transferring some unlisted shares to someone? No. So that is 0. What is B? B is jewelry, etc. Are we transferring some jewelry to someone? We don't have any jewelry, to take that as 0. What is A? Is the balancing figure of all the assets, book value. Take the book value of all the assets. So A is the balancing figure. B is jewelry, etc. C is unlisted shares, FMV, and D is immobile property, and L is liability. So A is balancing figure, take the book value. So the total amount comes to 147 lakh. What is FMV2? The amount which you have received in the form of money or non-monetary consideration. Are we receiving money? The answer is yes, 145 lakhs. Are we receiving any non-monetary consideration? The answer is no. Therefore, the answer to FMV2 is 145 lakhs. And therefore, whichever is higher will become what? Your sale consideration. And therefore, the answer of FMV or the answer of sale consideration would be 147 lakhs. And therefore, the 147 lakh is the sale consideration. 66 lakhs is the cost of acquisition. LTCG is 81 lakhs, and in case of slum sale, you might be knowing that you do not get what? Indexation. Is it clear to all of you? Indexation is not allowed in case of what? Slum sale. And one last question now. So the answer to this question is 81, as you can see over here. Okay. One last question over here. Mr. Akash, currently aged 40 years, is an Indian citizen who left for USA in the year 2009 for employment. He visited India for 15 days every year up to 17-18. He resigned his job in Microsoft and returned to India with his family on 15th of Feb 2019 permanently, and he opened a startup in Pune on 1st of March 2019. He visited USA from 1st June to 31st July, both in the calendar years 19 and 20 for business purpose. He has a house property in Dallas, USA, from which he receives rental income of US dollar 2,000 every month, which was credited to his saving bank account in Dallas. He paid municipal tax of US dollar 200 in December 21 out of the said account. Interest of $150 was credited in the said bank account in the March 2022. In previous year 21-22, he earned business income of 26 lakhs from his startup venture in Pune, in addition to interest on fixed deposit of 1,70,000 from the State Bank of India Pune branch. He deposited 1,50,000 in 5-year term deposit with the Bank of India Pune branch out of the rental income earned by him in USA. Compute his tax liability. Round off for AY 22-23, assuming that $1 is equal to 79 rupees throughout the financial year 21-22, and that he does not offer 115 BSE. We need to compute his tax. Now, before we compute his tax, we need to identify his residential status. The first thing which we need to do is to identify his residential status. What is his residential status? We need to identify that. Let us start with that. Shall we start? Please let me know. Shall we start with his residential status? Contact number is 900-900-8977. I'll put in the comment box. Okay. So now let us try and understand his residential status. For how many days he is staying in the current year in India? In the current year, he is staying in India for around let's see over here. When he has come to India, he is staying in India for around in the current year. That is the current year, previous year 21-22. How many days he is staying in India? He has stayed in India for almost the entire year except 2 months. Pay attention over here. Which 2 months? Pay attention. Mr. Akash is an Indian citizen who left for USA in the year 2009. In 2009, he left India. He left for USA. It means he left India. And he visited 15 days every year up to 17-18. Okay. And then he returned in 2019 to India. Okay. And then he is in India only. So in the current year, he is staying for a lot of days. Lot of days means only for few days he has gone out of India in 19 and 20. You can see over here, right? Only for few days he has gone out of India. So in the current year, he is in India only for most of the time because he is doing business. So he is a resident. There is no question about his residential status. He is a resident. But the question is he an ordinary resident? For him to become an ordinary resident, he need to stay in India in the last 7 days for 730 days. Do you agree? He has to stay in India in last 7 years for 730 days, and he should be resident in at least 2 out of last 10 years. Do you agree? So let us fulfill one of the condition. If he fulfills one of the condition, we'll talk about the second. If it does not fulfill one of the condition, there is no sense of talking about the second, because he has to fulfill both the condition to become an ordinary resident. So let us talk about 730 days. Is he staying in India for 730 days in the last 7 years? Let's talk about that. In 2021 and in 1920, he has stayed in India for only 304 days. So 304 days, how it comes to you, sir? Because in 1920, in 19 and in 20, he has gone out of India only for 2 months. That is for June and July. That means for 30 days in June and July 31, he has been out of India only for 61 days for the entire year. It means he was in India for 304 days in India for these 2 years. Okay? For these 2 years, he was in India for only 304 days. Now, what about 1819? In 1819, he came to India. You can see over here in the third line. On 15th of Feb, he came to India for the after a year. So on 15th of Feb 2019, he came to India. So he was in India for the month of Feb, say 15 to 28 Feb, that is for 14 days, and for March 31 days. So in 1819, he was in India for 45 days. Before that, he was in India for only 15 days every year, as you can see over here. He visited India only 15 days up to 1718. So up to 1718, he used to come every year for 15 days. So this is the data for the last 7 years. So if I total up these 7 years data, the answer will come to 713, which is lesser than 730 days. And with that note, I can say that he is a resident, no doubt about it, because in the current year, he is staying for a lot of days. He is staying for more than 182 days. But he is resident, but not ordinary resident. Now, which income is taxable for resident and not ordinary resident? It is not a resident and ordinary resident. World income is not taxable. Which income is taxable? Income has to either accrue in India or receive in India. Income has to either accrue in India or receive in India. Or if there is a business which is accrued outside India but controlled from India, then it is taxable. What about house property? House property, if it is outside India and received also outside India, it is not taxable for NOR. Interest, if it is accrued outside India and received outside India, it is not taxable for NOR. Therefore, what is taxable for NOR is the PGBP from Pune. Pune is in India, obviously. And interest on FD, because that is from State Bank of India. But he will not be liable for tax on this $150 interest which is credited in the bank in Delaware, in New York or Texas, wherever it is in USA. Similarly, he will not be liable for this rental income taxability in India, because this rental income is earned in US and it is also received in US. So rent is earned in US, received in US. Interest is earned in US, received in US. But 1,70,000 interest is earned in India through an SBI. So that will be taxable. Further, he has taken a term deposit of 5 years from Bank of India, that will be subject to deduction under 80C. 80C, because it is a deposit of 5 years term deposit with the scheduled bank, is subject to deduction under 80C. So he will get a deduction of 80C. Therefore, his total income will come to 26,20,000 rupees only. And his house property income will not be taxable in India. This interest income of 150 rupees, $150 will not be taxable in India, because it is not accrued in India, not received in India. In case of R and NOR, it is not taxable. If the assessee would have been R and OR, if he would have been ordinary resident, then entire income, world income would have been taxable. So now I am computing tax on this. If I compute tax on this, the answer will come to 6,22,440 rupees. That's it from my side. That's it. The discussion of MCQs are done. This is my task which I had to do for you all, and I have promised you all that I will be doing with you all. So I have done it. That's it. After this, there will be descriptive question which you can go through at your end. You will be also having the answers for the same. Okay. So did you all enjoyed? Did you all enjoy it? Did you all got the answers for all of them? Understood the answers for all of them? Let me chat with you all for 5 minutes. Please, guys. Please reply. Please reply. Don't shy. You can speak. Please reply. The same way I will also do it for mock test paper. Don't worry. Yes, Sachin, it is enough. Follow the revision videos which I am putting up on YouTube. Are you enjoying the revision videos of direct tax CA final November 22? Are you enjoying? Okay, take care all of you. If you have any doubts with respect to direct tax paper, feel free to ask me on this number. Don't worry. I'll try to reply with your doubts. You can also join my Telegram channel. 9009008977 is my WhatsApp number. This is for everything. If you have any doubts with respect to the subject, with respect to DT or with respect to paper 6C, feel free to ask, irrespective of whether you have learned DT from me or not. It doesn't matter. At this moment, there is some kind of humanity which has to be there in me also. Where if there is a student who is coming to me, I need to help them. Irrespective of whether you have learned from me or not, it doesn't matter to me. Okay. So I will try to answer all your questions to the extent it is possible from my side. And there is also my Telegram channel. You can join that also. Telegram group, in fact, where we solve doubts of the students. It's an open group. So take care, all of you. God bless you all and wish you all a very happy Independence Day once again. Take care and share this video to maximum of your friends. At least one person will share with 50 people, at least. That is something which you can do for me at least. I hope you will do. Right? Can I expect that much from you all? At least one person will share with 50 friends. Everybody will have at least 40 to 50 CA friends. Okay. I will just put the link of the Telegram channel also in the description. Don't worry. Okay. Akshata. Okay. Chalo, take care, all of you. Bye.